Good afternoon. This is Michael Bowling. I still see we have people joining us, so we're going to give it just maybe perhaps 1 minute, and then we will begin. Well, good afternoon, everybody. Folks are still joining us, but we're going to begin. My name is Michael Bowling, and on behalf of HLB Gross Collins, I would like to welcome you to our Navigating the CARES Act webinar. The act was signed last Friday to help businesses and individuals who may be struggling during this pandemic. The legislation is very complex, and I'm very excited that we have two great presenters today. Ileana Malinoff and Wayne Gilmore will be providing a detailed overview of the act. Ileana is the firm's tax practice leader, and Wayne is our service and technology practice leader. The CARES Act of 2020 is a $2.2 trillion aid package. This slide breaks out how the $2.2 trillion will be spent. Our webinar today will focus on the small business loans, loan forgiveness, and grants totaling $377 billion. Tax breaks for businesses of $280 billion. And on the individual relief side, we will focus on the tax credit rebates and the tax breaks of $311 billion. Our topics for today's webinar will be broken into 5 sections. We will start with the most commonly discussed topic, which is the SBA loan programs. Next, we will discuss the emergency paid sick leave and emergency paid family and medical leave, the employee retention credit and payroll tax delay. Then we'll talk about the business provision and incentives, and we'll finish with the individual rebates and other tax incentives. Before we begin, just one quick note. If you have a question during the presentation, please type it in the questions section on your control panel and select send to all staff. We know there will be a lot of questions today, and we will do our best to answer them. Please also note the handouts, which are listed in the handout section of your webinar control panel. With that, I'll hand it over to Ileana, who will get us started.
Good afternoon, everyone. My name is Ileana Malinoff. Thank you, Michael, for having us today on this wonderful webinar for our clients. As you said, the SBA loans are probably the #1 question that our clients have already begun sending us, and it's probably the #1 incentive under the bill that actually gets the most attention in the media. Therefore, even though you don't normally think of your CPA firm when you think about loans, you actually think about your banks, we will actually talk about SBA loans. The SBA loans were created as part of the Paycheck Protection Program in the act that passed this Friday, the Coronavirus Relief Act, or the CARES Act. And as I said, it was probably one of the most highly anticipated measures because it does provide direct financial relief to businesses that are struggling to keep their operations afloat. This SBA loan provision is actually a temporary extension of the already existing SBA program. The loans were known as SBA 7A loans. So if you've ever applied for an SBA loan before, that's probably the type of loan you had, and that's the type of loan you're going to have now. But to avoid confusion, we are going to address the new type of SBA loan as the Paycheck Protection Program, or the PPP loan, or maybe the 3P loan. I don't know what's going to stick in the media, but those are the names that I have heard. So the Paycheck Protection Program loans are going to provide $349 billion in loan guarantees, subsidies, and additional funding to small businesses in the United States. The maximum size of the loan is up to $10 million, and some or all of the loan could be eligible for forgiveness. There is some sense of urgency to apply for the loan, as you must apply before June 30th of 2020. And things are changing so rapidly with the SBA loans that from the time we put this presentation together over the past 3 days, we already received new guidance last night, and we received a tentative SBA application form for this loan, which wasn't available until late last night. So this shows that the SBA administration was working closely with Congress so that this direct financial relief can be made available more quickly to you. So this is one of the handouts in your handout section. If you'd like to download it later for future use, it contains the current Paycheck Protection Program application form as of yesterday, and this may be subject to revisions, as well as something published by the SBA that is referred to as a borrower guide. The borrower guide contains some of this information that we're going to cover today. I think we're going to go in a little bit more detail. You know, they wanted to fit everything on several pages. We are going to try to provide as much detail as possible, which I think will also answer many of your questions. And thank you to those of you who submitted questions during the registration process. That was extremely helpful for us as we were preparing for this presentation, because we wanted to hear from you and know that what we deliver today is actually going to be useful. So who can qualify for the new Paycheck Protection Program? The Paycheck Protection Program applies to businesses or business concerns, as the law phrases it, with fewer than 500 employees. That immediately raises a couple of questions. What is a business concern, and how do I count 500 employees? While the CARES Act provides some clarification to the 500 employee rule, it does not provide significant clarification to what a business concern is. Therefore, for right now, in absence of additional guidance, we think that the traditional SBA rules related to what a business concern is would apply in this case as well. And for the most part, those are businesses operating in the United States that do not have majority foreign ownership. Additionally, on the 500 employee rule, there are several exemptions. If you are in an SBA industry where the SBA has already established a different size, and there's a guide in the SBA regulations that can tell you if your industry size on an employee basis is different. There's very few of those industries. If you are in the accommodation and food service sector and your NAICS code starts with 72, the 500 rule will be applied to you on a per location physical basis. Also, if you operate as a franchisee or franchisor, or if you receive any kind of assistance from the Small Business Investment Company, you will not have to do the normal affiliation rules. What are the affiliation rules? When you count your 500 employees, you're actually supposed to look at all of the companies that you're affiliated with, meaning there is 50% or more common ownership, and there may be also entities that you'd have to aggregate under contractual control. So that can present some unique challenges for businesses with a more complicated capital structure and private equity funding. How to apply and what is my maximum loan amount? So as of yesterday, we were going to tell you that you have to apply with your SBA lender and that we don't know how. We were going to give you a list of recommendations. However, as of today, we can tell you that you are able to begin applying on April 3rd. This loan will absolutely be administered by SBA approved lenders. So I know that all of the SBA lenders in the area are working on putting together checklists and guidance to their clients so that they're ready to accept applications on April 3rd, and so that they can streamline this process as much as possible. Additionally, we are expecting that under the express authority given in the bill, more lenders will actually be able to join the SBA program quickly. For those of you that are not familiar with the SBA website, that's actually a great resource. The SBA has been doing a really good job over the past couple of days of updating the website and giving current guidance. One point of reference, if you don't already have a banking relationship with the SBA lender, is that you can use their online search tool, which is called SBA Lender Match. And we've put a link to that in our presentation so that you can see SBA lenders around you that should be able to help. The maximum loan amount is determined by multiplying your average monthly payroll costs by 250%. The average monthly payroll costs are actually vary depending on whether or not you are a seasonal employer or how long you've been in existence, and we'll address that in a minute. Additionally, it's really important to point out that the SBA rules for the Paycheck Protection Program Act have been modified. So under traditional SBA loans, there were certain limits associated with the net worth of the applicant, and there were certain limitations associated with the previous taxable income of the applicant. For this particular loan, when you complete the application, if you do meet the 500 employee requirement, the only thing you need to do is make a good faith certification that the uncertainty of current economic conditions makes it necessary for you to request this loan so that you can keep people employed and support your ongoing operations. Additionally, you are affirmatively making a certification that you will only use the funds to retain workers and maintain payroll, or to make mortgage payments, lease payments, or utility payments. Finally, because the government was already expecting that there's going to be huge interest in this program, you're also certifying that you do not have any other pending application with another lender for the same type of loan with the same type of payroll costs to be covered. Essentially, you cannot reach out to all of your banking contacts and see who's going to process your application first. So it's really important that you get in touch with your banking relationships, your bankers, make sure that they are ready for this program and sort of determine who's the best fit for you. So how do we calculate the maximum loan amount? As I said, we have three different options related to your payroll costs. For businesses that were operational on February 15th of 2019, you're actually going to calculate your average monthly payroll costs for the 1 year period before you apply for the loan. So February 15th was really chosen sort of as the time maybe when the date when the pandemic started to spread, a little bit before the president declared the national emergency. So the goal with this test is really to get the most current annual period for payroll. For businesses that were not operational on February 15th, 2019, you are actually going to consider only your average monthly payroll costs for the period January 1st to February 29th, 2020. And then for seasonal employers, you have a little bit of options. You can consider your average monthly payroll costs for the 12-week period beginning on February 15th, 2019 or March 1st, 2019, and you can decide which one of these formulas gives you the better result. So as I said, the maximum amount of the loan will be 2.5 times the average monthly payroll cost computed under one of these three methods, whatever is applicable to your business. Additionally, if you have any other outstanding EIDL loans at the time that you make this application, the balance of those loans will be added to the maximum loan amount that you can borrow should you want to refinance those loans. And we're going to get into the emergency injury disaster loans, the EIDA loans in a minute as well. What are payroll costs? I said payroll costs several times over the preceding slides, so by now probably some of you know what they are, or others are wondering, as this is a key component of determining how much you can borrow. So payroll costs include salaries, wages, commissions, and similar compensations paid to employees, together with any kind of separation payments, retirement benefits, payments for continuation of group health benefits, including health insurance premiums covered by the employer, any paid vacation, sick, or medical and family leave, as well as any state and local unemployment or other type of taxes that the employer may be responsible for. A lot of the questions that were coming in had to do with payments for independent contractors, and our read of the law in the absence of further guidance is that you should be able to include compensation paid to independent contractors that is really for services. So for example, you know, maybe you have somebody who is not really an employee but is providing marketing services for you. That would be an example of compensation that could be included in this calculation. What is included from this calculation is the compensation of anyone in excess of annualized annual salary of $100,000. So both contractors and employees, when you are doing your calculation of the average 12-month payroll cost, you are supposed to sort of right-size the compensation for everybody. And that also includes people who maybe you did not have on payroll for the entire year. So say that you hired somebody in February and their annual salary was $150,000. When you compute your average payroll for February, you need to adjust the individual compensation for that person down, not to exceed what would have been a $100,000 annualized salary. Additionally, you cannot consider for this calculation any payroll taxes, any other railroad retirement taxes, and any income taxes. You also cannot consider the compensation of any employee or any independent contractor whose place of residence is outside of the United States. And I know that in this global economy, many companies actually rely on services provided from either employees or contractors outside of the United States. So definitely exclude those. And we haven't really talked about the Families First Coronavirus Response Act, and that's coming up in the next few slides. But if you are an employer who has already begun paying emergency paid sick leave or emergency paid family leave under the Families First Corona Response Act, you will be entitled to a credit for those wages. Therefore, you're not allowed to consider those wages in the computation of the Paycheck Protection Program loan. So essentially no double dipping in benefits. So here is an example. It's a rather simple example, and we've been working over the past few days to try to develop and model out a maximum loan computation with all of the variables. So we'll be happy to help you if you're encountering issues in calculating that. But for now, we're going to go over a relatively simple example. ABC Company applies for the Paycheck Protection Loan on April 15th. See, this was written when I didn't know they'll be able to apply on April 3rd. The business had total wages between April 16th of 2019 and April 14th of 2020, the 12-month look-back period of $15 million. After adjusting for excess compensation of employees making over $100,000 and adding health insurance premiums and other allowable payments, the business determined that their total payroll cost is $12 million. Therefore, average monthly payroll cost is $1 million and the maximum loan amount is $2.5 million. All right, this is a very key point. Once we get the loan, what can we do with it? Remember that certification that we talked about where you were affirmatively stating that this loan is needed so the business can continue as an ongoing concern and you're committed to using the funds from the loan to keep people on payroll and pay rent. So there are actually restrictions on the loan proceeds. And you can use the loan to cover payroll costs, that definition that we discussed a minute ago, rent, payment of interest but not principal on any mortgage obligation, utilities, and interest on any debt obligations incurred before February 15, 2020. It's important that this is for, the covered period, and the rent agreements and the debt agreements have already been in existence before February 15th of 2020. As best practices, and we haven't really talked and gotten a good opinion from the SBA bankers, but as best practices and as accountants, we know that cash is cash and it could be considered fungible. Therefore, we think that businesses should consider using a separate bank account to deposit the PPP loan proceeds and then the subsequent disbursements, so that it provides for easy accounting and for easy way to prove that all of the loan uses were within the permitted uses. Key loan terms. There's a lot of good stuff on this one slide. So those of you who have applied for an SBA loan before know that a lot of the SBA loans required personal guarantees or collateral. For this particular loan, there is no requirement for personal guarantees or collateral. There is also no requirement that the business cannot obtain credit elsewhere. Additionally, there's no recourse against any individual shareholder or owner of a business for non-payment, except to the extent that this person has decided to use the funds for any unauthorized use. There are no loan origination fees during the covered period. There are also no guarantee fees that, the SBA lender was previously able to charge you. Additionally, every loan is guaranteed by the SBA until December 31st of 2020. The maximum interest rate in the law was stated to be 4%, and the maximum loan maturity is 10 years. And this is where our, 3-day-old presentation is already dated, because the guidance that came last night and what's available from the Department of Treasury that has been tasked together with the SBA to administer this program is that the interest rate for the loan is actually going to be 0.5%, and that the maximum loan maturity is 2 years. So the way that the law was worded, it's at up to 4% and up to 10 years. So technically, Treasury reducing both the rate and the repayment term of the loan was within what Congress had intended. Additionally, you will qualify for a deferred interest, principal, and fees for a period no less than 6 months after your loan period begins and no more than 1 year. Finally, a very important point, maybe we should have made it in red, the loan forgiveness amount is not included as income for federal tax purposes. There's no guidance on the states yet, but we're expecting that some states will follow as well. And now we are coming into a little bit more of a technical or mathematical computation related to what part of the Paycheck Protection Program would qualify for loan forgiveness, or as other people can say it, free money. And is it really free money? So we were talking that we hope that all of you take this webinar absolutely seriously, even though it's April 1st and it's supposed to be April Fool's Day. We are doing our best to give you accurate facts. And if this sounds like too good to be true, please know that it's not an April Fool's joke. This is what the law intended, and that was for businesses to actually qualify for loan forgiveness if they keep their employees on payroll. So the maximum loan forgiveness amount is equal to the actual payments during your covered period, which is the 8-week period starting with the loan origination date. And the allowed expenses, as I said, were payroll costs, rent, utilities, and interest on covered mortgage and debt obligations. However, the forgiveness amount can possibly be reduced if you experience a reduction in workforce or if you experience a reduction in workforce compensation. Trying to move to the next slide. Sorry about that. So what really means reduction in workforce ratio? It looks like a complicated formula. I think it takes a little bit of time to sort of wrap your mind around it, and then you'll actually get comfortable with it. But the reduction in workforce ratio is the average, is computed by determining the average number of your full-time employee equivalents during the 8-week covered period, divided by your average number of full-time employees in a previous period, and you get an option to choose which period works better for you and what really represents better what your normal workforce was. So this is at the choice of the employer, the applicant, and option 1 is to calculate your average number of full-time employees per month between February 15th and June 30th of 2019, which is almost, the period between what we're dealing with now and the workforce that you had a year ago from now. Or option 2 is to calculate the average number of full-time employee equivalents per month between January 1st and February 29th of 2020, which gives you a point of reference before the coronavirus pandemic started. So employers are allowed to calculate these fractions. And obviously, the lower your reduction, the lower in workforce ratio reduction you have, the higher amount of loan forgiveness you will have because you have retained more employees. Additionally, you also have to calculate whether or not you experienced any reduction in workforce compensation. And reduction in workforce compensation is defined as a reduction of more than 25% in salary or wages during your covered period for any employee who did not receive more than $100,000 of annualized wages in the previous year. So the intent of the law here was for employers to try to keep salaries consistent, even if they actually have to reduce them a little bit for their employees that make annualized income of less than $100,000. There is an important exclusion here that I'd like to highlight because many of you may have already considered layoffs or had layoffs of your workforce. If there was a reduction in your workforce between February 15th of 2020 and April 26th of 2020, there is an exemption that if you do rehire your employees back by June 30th, the reduction in pay for these employees will be eliminated from the computation. So essentially, you will be able to qualify for a higher loan forgiveness amount. So we tried to put that in a picture so that you can calculate possibly your loan forgiveness formula. And as I said, we'll be happy to help with that. But you do have to track carefully any actual payroll costs, actual rent, utilities, and interest that you paid during the 8-week covered period, and then multiply that total spending from the loan proceeds by your reduction in workforce ratio. And that is your loan forgiveness before reduction in workforce compensation. Then you calculate your reduction in workforce compensation, that 25% decrease that we talked about. And if there is any, you subtract it, and that's how you arrive at your loan forgiveness amount. So there's a couple of interesting points about the loan forgiveness amount. This sounds like a lot of payroll data, and it sounds like a lot of calculations, and it is. However, the current guidance says that the SBA lenders are supposed to administer both the loan application and the loan forgiveness. So I think that they will all have to get really comfortable really quick with payroll calculations and total cost of payroll. And I think it is important to start collecting this data and thinking about the sources of this data now. Once you submit your application for loan forgiveness, the SBA lender will have 60 days to approve it and let you know what amount of the loan is actually forgiven. That brings me back to the economic injury, next to the economic injury disaster loans. I think that some of you may have already applied to these, and we kind of wanted to highlight what has changed with the economic injury disaster loans. These loans have been around before the current pandemic, and after the president declared a national emergency, more and more businesses could actually qualify for an economic injury disaster loan. However, this is more similar to the traditional SBA rules that you are used to compared to what we just talked about in the Paycheck Protection Program. For example, the economic injury disaster loan still requires a personal guarantee or collateral if your loan is over $200,000. The economic injury disaster loan comes with a pretty significant application package that needs to be completed, which is also in your handouts. The SBA has tried to simplify that application process, and you can actually apply online directly with the SBA. The economic injury disaster loans also carry a net worth element and a taxable income element, but the reason why we wanted to highlight them in today's presentation is because this is another source of cash flow available to you before the Paycheck Protection Loan gets available to you. You can apply on April 3rd, but there's still going to be a processing time for it. Additionally, the economic injury disaster loan comes with an emergency grant option, and that grant option is what Congress added in the CARES Act, and you can receive an immediate advance of up to $10,000 to maintain payroll. If your application is actually not approved, you do not have to repay that $10,000 back. Obviously, everybody would prefer to get the complete loan that they need rather than free $10,000, but it is something, and it is source of cash flow available. If at the time at which you apply for the Paycheck Protection Program, you have already obtained an economic disaster loan, the application asks you if you have one and what is the outstanding balance on it, and you have the opportunity to refinance the economic injury disaster loan into the Paycheck Protection Program loan. Additionally, the CARES Act provided a subsidy for those of you with existing SBA loans, and the SBA will cover 6 months of principal, interest, and fees on qualifying loans. So that brings me to the next point. What records should a business keep, or what records should a business start collecting? So for the SBA application, as I said, the lenders are working on putting together a complete and accurate list. They're working together with the Department of Treasury, and the borrower guide and the application that we shared with you in the handouts kind of gives you an idea of what you need to begin collecting. First and foremost, accurate payroll records for the appropriate period for your business. And second, we don't know that the SBA lenders are actually going to be doing the payroll calculation. So we are recommending that if there are any adjustments to your payroll costs, we are recommending that businesses, with our help if needed, put together a schedule and a tentative maximum loan computation that the SBA lender can then take and verify, rather than just giving them 941s or transcripts of payroll and wages and expecting that they'll be able to efficiently work through all that data. So possible additional documents are things similar to what the SBA has required before, such as financial statements that are current within 180 days from the application, projected financial statements if you want to show the impact that this business is going to have on your company, as well as any business certificates and licenses, ownership and affiliation documentation. As I mentioned, that's very important for the 500 employer rule. There will be certifications by anyone who is more than 20% owner required with the application, and then payroll tax schedules and tax filings. You should keep similar documents for the loan forgiveness calculation. I know that we're just going to get over the hurdle of applying for the loan, but the 8 weeks go fast. And then once your 8 weeks are up, you are eligible to submit your documents for loan forgiveness. So we might as well be prepared now what information to collect. So payroll tax filings, Forms 941, 940, W2, W3, both for the 8-week period, but also for the look back period that you're going to use to compute your workforce reduction ratio, to show that hopefully you don't have a workforce reduction if you didn't have to lay off people. So they will need to be able to verify your full-time employee equivalent, both for the 8-week period and also for the previous period that you're using as a comparable. And then you will need to have documentation verifying that your disbursements from the loan proceeds were actually only for approved expenditures such as rent, utilities, and interest payments. And that would be canceled checks, payment receipts, transcripts, and other documents supporting how you spend the money. Finally, at a glance, I wanted to compare the two loans for you. So the EIDL is available now if you have an urgent need, and you can apply with the SBA directly online, whereas the PPP will be available April 3rd, and you will apply with the SBA lender. You can see here that we haven't updated that slide yet to show that under the Treasury's guidance, the term for the PPP will be 2 years and the interest rate will be 0.5%. But I think that's a good slide as you're trying to evaluate your options. And we're actually going to make the whole presentation available to you when the webinar concludes, so you will be able to have that in your records. We also included here the PPP application form and in the handouts, and that's what I have been referring as I was telling you about the current updates. It is kind of interesting that they are asking about the number of jobs that your business has, but on the surface of this application, they're not really delving too much into the controlled or affiliated group rules. They are asking about your average monthly payroll. As I said, anybody with more than 20% ownership stake, and you will probably have to go all the way up the physical chain of ownership of your entity until you reach until you reach the top to list everybody who has a 20% ownership stake. All of the individuals that are greater than 20% owner must sign and certify all of the questions that are traditional for the SBA loans and make all of the representations. And that's it. It looks like a deceivingly simple form. It's only 2 pages and half of it is certifications. But I do think that there's a significant amount of calculations and thought that may have to go into this for some of you. I hope that this answered most of your questions that we have been receiving via email and also through your subscriptions. If we didn't answer anything, please feel free to use the chat box and send questions, and we will respond to you individually after the presentation. With that, I'm going to turn it over to Wayne, who is going to talk about the next hot topic, employee retention payroll tax credits. Wayne?
Thanks, Ileana. Good afternoon, everyone. My name is Wayne Gilmore. Good to be with you this afternoon. In addition to the SBA loan programs, there's also several other individual and business provisions in the CARE Act, and we're going to talk about some of those now and a little bit later into the presentation. But two big provisions on the business side of the CARES Act are the employee retention payroll credit and also the deferral of payroll tax payments. The goal of the government is to get as much cash flow into the hands of businesses immediately. Number one, to help with employee retention, and number two, just with general operations and getting through this COVID hump that we're all going through. Starting first here with the employee retention payroll tax credit. This is a refundable quarterly credit against employment taxes to encourage retention of employees who are not working either due to a full or partial cessation of business that's occurred here in the last month or so. Eligible employers for this include employers carrying on business in 2020 and whose operations were fully or partially suspended due to a COVID-19 government mandated shutdown, or employers whose gross receipts have declined by greater than 50% when compared to the corresponding calendar quarter of the prior year. So if you're looking at, February, March, April, the prior year, they're looking at that time frame compared to now to look for that 50% drop. And what's a little bit different with these programs compared to the PPP program Ileana was discussing, just good faith certification is needed for the PPP. And under this employee retention credit, you have to actually show that the government shut us down, shelter orders, or we have dropped by indeed 50% in order to claim this. How is the credit computed? Well, the refundable credit's applicable for wages paid between March 12th, 2020 and before January 1st, 2021. The credit is actually equal to 50% of qualified wages up to $10,000 in wages per employee, putting the maximum credit at $5,000 per employee. So eligibility for the credit begins with the first 2020 calendar quarter in which the employer's gross receipts declined by greater than 50% of the corresponding quarter in the prior year. And you can keep claiming the credit if you reach that 50% level until you come back up to recovering to 80% of the prior year level. So there's a possibility to run this out for second, third, and fourth quarter here in 2020, as long as our revenues do not go back up to that 80% level. The credit also mentioned worth saying here is reduced by any credit taken in relation to other wage-based tax credits, and credits due to paid and sick leave and FMLA, which we're going to discuss here in a minute. And then also any credits taken for work opportunity tax credits, things of that nature related to payroll, that would actually reduce this credit. So like Ileana said before, we're not taking a double dip on these items. So once we find out that we're a qualified employer, we have to have qualified employees, and it must determine which employees are qualified. The definition of qualified employees based on whether the employer had more than 100 full-time people or 100 or fewer at during the tax year 2019. If an employer had more than 100 full-time, employer will be qualified if he or she is unable to provide services due to business suspension or gross receipts decline. That is literally the employee is at home and not working. If an employer had 100 or fewer employees, employer will be qualified as long as the business suspension meets the gross receipts detailed above, or whether or not the employee is able to provide services is not really a factor when there's 100 or fewer. The employees can actually still be working, even working remotely from home, and that would still qualify in a business that has 100 or fewer in this case. Qualified wages for this credit, it's of course W-2 wages, including health benefits. The qualified wages may not exceed the amount of qualified employee would have been paid for working an equivalent amount of time during the 30 days immediately preceding the quarter. So what they're saying here is you can't all of a sudden put everybody on a big raise in order to get more credit than they were being paid in the prior 30 days. That has to stay at a level playing field, if you will. Qualified employers that receive paycheck protection programs Ileana was describing are actually not eligible for this credit. So governments, if they're going to give you that payroll protection loan, are not going to also give us this potentially very large credit. So this would not apply if we have the PPP program. How do we see this coming through on tax returns or forms? We anticipate a Form 941 having a change for a separate line item for the insertion of the credit, actually onto the quarterly payroll tax return. And if we're anticipating the credit, there is opportunities also to cut down on our tax deposits we're making throughout the quarter to help free up cash flow immediately in this case. Here's another very large, powerful way to defer some money into later programs, later periods. Delay of payment of employer payroll taxes. The CARES Act under Section 2302 aims to free up cash flow and encourage retention of employees during the COVID-19 quarantine. For the period March 27th through December 31st, 2020, all employers may defer 100% of applicable payroll taxes, and self-employed individuals may defer 50% of their self-employment tax without penalty. And that's worth mentioning, individuals that are self-employed on a Schedule C, that's how they pay in Social Security and Medicare taxes, through self-employment tax on Form SE. And the government's also paying attention to them in addition to large businesses and letting them defer payment on these as well. So what qualifies to be deferred? So the applicable payroll tax that can be deferred is only the employer's 6.2% of Social Security tax employer portion. So you'll recall that FICA is made up of Social Security and Medicare. 6.2% is Social Security. Medicare is 1.45% of that 7.65. The employee gets that taken out of their W-2 paycheck. The employer is required to match that. Well, in this case, that's what the government's letting us defer as our employer matching portion of the Social Security. The 1.45 Medicare tax is still required to be paid timely, however. That cannot be deferred. Half of the amount deferred is due on December 31st, 2021, and the remaining half is due December 31st, 2022. So it's quite a distance off. A lot of people use professional employee organizations, PEOs, even though the company itself is not paying the employees. The PEO is the ID number on the W-2 and so forth. We can direct those PEOs that we want to participate in this program and to defer taxes for us. Important to note, though, that the company is totally on the hook if something would go wrong at the end of 2021 or 2022. The PEO is not held liable. All the penalties would come back on the individual employer. So that's something to keep in mind there. And the payroll deferral, once again, is not available to employers that have debt forgiven as part of the CARES Act under our payroll protection program that Ileana discussed before as well. So it's kind of either we're going to participate in that prior program, or if not, we can definitely take advantage of these provisions here. A quick example for us, say an employer has quarterly payroll of $100,000 with 5 employees. None of these are expected to reach the Social Security wage base max of $137,700 in 2020. So the quarterly employer portion of the Social Security liability will be $6,200 per quarter. So that's 6.2% of our $100,000 of gross wages. So under this program here, the total employer portion of tax due from April 1st through December 31st, covering a 3-quarter period, would be $18,600, $6,200 times 3 quarters. Half of this amount, $9,300, will be due by 12/31/21, way off in the future. The remaining half will be due by 12/31/22, even further off in the future. So even this example of 100,000, if you're talking millions and millions of dollars with an employee payroll, it's quite a deferral opportunity for clients. paid sick and FMLA leave. We have gotten a lot of questions on this topic. It's a highly technical area, often involving employment attorneys for verification. But we wanted to give you a summary of the basic rules going on right now, and especially with the last passage last week of the CARES Act. On March 18th, the president signed the Families First Coronavirus Response Act, FFCRA. It's important to note the CARES Act is actually the third act passed by Congress, the third bill since the coronavirus issue came about. The second of the three was the FFCRA. The third of the three is actually the CARES Act, which is passed here this past Friday. But these rules under the FFCRA are actually effective today, April 1st, 2020. And the requirements will expire on December 31st, 2020. So it's meant to protect employees for this short, 3-quarter time period that we're expected to have the worst of the virus happening. A covered employer, this is going to cover all employers with fewer than 500 employees, which is a lot of companies, as well as government employers. The employer is responsible to inform employees of these programs. And actually, the employee is also responsible to give written notice in line with existing FMLA requirements if they're requesting time off for a qualified FMLA reason. So we're going to talk first here about the sick leave. What this encompasses for full-time employees, they're going to receive up to 80 hours of pay, which is basically 40-hour weeks over 10 days. It's a 2-week period. Part-time employees will receive the average number of hours of work that they work over a 2-week period, if that's pretty much a set schedule. Now, if the part-time employee schedule varies, the formula is the employee receives the average number of hours scheduled per day over the prior 6-month period, including hours which the employee took any type of leave. So that takes a little more calculation in that case. What are the reasons that employees would need to use this? Well, an employee qualifies for emergency paid sick time, assuming the employee cannot work or telework. That's very important. Employees cannot be teleworking either in this case for any of the following 6 reasons. The employer is subject to federal, state, or local quarantine or isolation order. County shutting down businesses, restaurants, gyms, so forth. That is a federal, local quarantine mandate. Number 2, the employee has been advised by a healthcare provider to self-quarantine due to COVID-19 concerns. Number 3, the employee is experiencing symptoms and seeking a medical diagnosis. The government is requesting they stay home and they're covering them for that. Number 4 applies to really dependents, not yourself personally, but your family members or your children, starts 4, 5, and 6. The employee is caring for an individual who is subject to government quarantine or isolation order, or has been advised by a healthcare provider to self-quarantine. Number 5, the employee is caring for a child because the child's school or place of care has been closed, or the child care provider is unavailable. And number 6, the employee is experiencing any other substantially similar condition specified by the U.S. Department of Health. So number 6, really makes it flexible for employees if they really need to take advantage of this. Once again, note on teleworking, a lot of us are teleworking, our employees are. If the employer and the employee agree that the employee will work the employee's normal number of hours during the week, but outside of the normally scheduled hours, then the employee is able to work, and this paid leave is not necessary unless a COVID-19 qualified reason comes into play. So, we have several staff that have small children, and it's best they like to work early in the morning, be with family throughout the day and those responsibilities, and then work again later in the evening. That is totally fine, and the paid sick leave would not apply in those cases. So employees' own care. So for reasons number 1 through 3 on the previous slide, where the employee receives the greater of employees, where the employee is taking care of themselves, what's going to happen is the employee is going to receive the greater of the employee's regular pay or pay of the applicable minimum wage, but pay is capped at $511 per day. So if an employee is out because of a COVID reason for themselves personally, that's going to be 10 days at $511. or $5,110 in total. Now, if they're out for caring for a reason on number 4 through 6 on the previous slide, caring for a family member or a child, that's going to be a little bit less. It's going to be 2/3 of the employee's regular rate or caps at $200 per day. So over a 10-day period, that'd be $2,000 in total that the employer would be responsible for to pay that employee. There is good news. The tax credits provided by the government are available to employers, and these tax credits are equal to 100% of the FFCRA mandated paid leave wages by an employer each calendar quarter, subject to certain caps. But this also includes Medicare taxes on those wages, the expenses associated with maintaining group health plans, their health insurances, and the wages. So the caps of the 511 per day and the 200 per day, the tax credits would cover every bit of that if an employer would need to pay that to their employees. The second part of the employee FFCRA is the Emergency Family Medical Leave Expansion Act, expanded FMLA. This is the second part, not related to sick pay. So in addition to the sick pay leave credit under the expanded FMLA, an employee who's unable to work, and that includes telework, because of a need to care for a child or whose school or place of care is closed, whose child care provider is unavailable, is entitled to paid family and medical leave equal to 2/3 of the employee's regular pay, up to $200 per day, and $10,000 in the aggregate. So this is really applying to child care facilities and children having to care for, if there's no other options, the parents have to be home. This is applying to that, this emergency expanded FMLA. Now what this does, this gives up to 10 weeks of qualifying leave and can be counted towards the family leave credit. So what happens over a 50-day period at $200 per day, if it would get to be 50 days, that's the max of the $10,000 that's in this provision. If we have to take sick pay and FMLA leave pay, the ordering is the first 10 days will be sick leave that we discussed previously. Then up to the next 50 days, 10 weeks will be family medical leave. The employer may claim a fully refundable tax credit equal to 100% of the qualified family leave wages, plus applicable health plan expenses, insurances, and the employer's share of Medicare tax. So once again, small businesses are definitely liable for this. They need to realize they're liable for it and follow the law, but at the same time, we can claim tax credits. And those are actually done on the employee, Form 941. These are employment refundable credits, and get that money back into the hands and the coffers of the businesses. Now, one of the concerns of businesses, if you're having to pay this out and the timing of it, usually you file your Form 941 at the end of the quarter, and, having to float those payroll tax deposits up until then, a lot of companies are struggling, hanging on, and don't have the cash flow for that. The IRS has actually just come out with a new Form 7200 that we can use to request an advance payment of these tax credits for qualified sick, qualified family leave wages, and also the employee retention credit that I talked about first here in this presentation. And you'll claim those on this Form 7200, and it will mostly apply to Form 941 for our small businesses that we work with. And we actually have an example of that here on the next page. And it's a relatively easy form. You fill out your business ID and name at the top. Tell us about what employer tax returns you're filing. Most are going to be Form 941 in Part 1. And then Part 2 is where you actually request your credits in advance. So you can see there total employee retention credit for the quarter. Part 2, number 2, total qualified sick leave wages eligible to compute that. Number 3, total qualified family leave wages eligible. So we can get money in our hands fairly quickly by utilizing this form. And with that, we'll turn it back over to Ileana to discuss some more business provisions of the CARES Act.
Hello, everybody. We're going to change gears a little bit. And for the next few minutes, when we cover business provisions and individual provisions, you're not going to hear much about payroll costs or payroll related credits. Instead, we're going to be talking about some very powerful changes that the CARES Act provided that provide an alternative way to hopefully supplement your cash flow. The most important pieces in our read of the CARES Act were the extended ability to claim net operating losses, the newly expanded and increased interest expense limitation, the new accelerated depreciation for qualified improvement property, and then a couple of other business provisions worth mentioning. We have received a lot of questions about net operating losses. Some of you want to start filing now or as soon as possible. We unfortunately don't have any guidance from the IRS or any amended forms that allow to be able to start working on these net operating loss claims. But let me tell you what has changed and why it's such a big deal. Before the Tax Cuts and Jobs Act came around, we were used to a 2-year carryback, which allowed most business owners, if they had a difficult year, to carry back the loss and recover income tax payments that they have made in previous years. That was a good and relatively quick source of cash flow because even though you could carry forward the loss over 20 years, there was certainly a lot of uncertainty with the timing of how exactly you're going to monetize that loss. We were used to having net operating losses offset up to 100% of taxable income. So even though you had a tough year, a net operating loss sort of had a silver lining. After the Tax Cuts and Jobs Act came around, effective for years 2018 and 2019, we have no carryback provisions whatsoever. Instead, there's an indefinite carry forward, but as I just mentioned, it's difficult to imagine how exactly you're going to monetize those carry forwards when you're having a hard time. Additionally, we were imposed with an additional limitation of 80% on taxable income, meaning that every year, no matter the size of your net operating loss, you would be paying tax on 20% of your other income. With the CARES Act passed on March 27th last week on Friday, we now have an expanded carryback period of 5 years. This carryback period applies only to net operating losses that were generated in 2018, 2019, and the ones that some businesses are anticipating for 2020. And the carryback period essentially means that you can carry your net operating losses all the way back to the 2015 taxable year. As you can imagine, the IRS is going to need a minute to prepare a net operating loss carryback form that covers 5 years. They had one about 10 years ago when we were going through tough times again, and hopefully they will be releasing this soon. We get to keep the indefinite carry forward, and equally important, the net operating losses for these 3 years only are can offset up to 100% of taxable income. In the absence of any additional legislation, this is a temporary provision that applies only for the years 18 through 20, and then we will revert back to the Tax Cuts and Jobs Act, unfavorable, in my opinion, net operating loss rules. One thing that we wanted to point out, because if you haven't heard the common theme, it's all about cash flow and how these tax provisions can help the businesses get their hands on funds quicker, is that there are going to be tentative refund applications available for the NOL carrybacks. They typically get processed by the IRS a little bit faster, and we've listed here the key dates on when we should apply for those net operating carrybacks. So as you can see here, for fiscal year filers in the 2017-2018 fiscal year, which was not the current fiscal year, not last, but the previous one, there's not a lot of time, relatively. There's 3 months. And so if this applies to you, we should definitely discuss this further. Additionally, we would still, as a technical matter, if you choose to forgo the carryback period, we'll have to do an election for that. And for those of you with international operations or exporters, the NOL carryback impacts your taxable income calculation as it relates to any Section 965 inclusions and as it relates to any Section 250 deductions and inclusions. So if this impacts you, it may be a little bit of a bigger of an exercise to figure out the benefit of the net operating loss carryback than just thinking of it as accelerated refunds. The NOL carryback can also have an impact on any qualified business that takes a deduction under Section 199A or the so-called 20% qualified business income deduction. Our next topic is the interest expense limitation. I know that some of you have been severely affected by the interest expense limitation. Before the Tax Cuts and Jobs Act, there were really very few limitations on how much interest expense can be deducted as a reduction of taxable income. For US companies, there were very, very few limitations. A notable limitation was for foreign-owned companies doing business in the United States because they were subject to earnings stripping rules. Under the Tax Cuts and Jobs Act, the old rules were repealed and a very unpopular rule was implemented. This rule impacted everybody with a more sort of heavily leveraged balance sheet because it limits the deduction of interest expense to 30% of your adjusted taxable income, and then you end up with an excess carry forward. Some of you may not be familiar with this rule because there was an exception for businesses with less than 25 million in gross receipts, and there were exceptions for real estate trade or businesses. However, many of you may be familiar with it. After the CARES Act, we now have a 50% limitation. So you are able to deduct more of your interest expense compared to the previous rules. This applies only for 2019 and 2020. So if you already filed your 2019 return and you are subject to the 30% limitation, let's talk and figure out the benefit in amending and claiming the additional deductions. For 2020, you also have the ability to substitute your adjusted taxable income for the 2019 adjusted taxable income if that will allow you a bigger deduction, as many businesses are expecting significantly lower adjusted taxable income compared to previous years as a result of the pandemic. The qualified improvement property change was a long-awaited technical correction. So this is one of the biggest, or this is probably the biggest tax bill, not only in dollar amounts, but sort of in size and affected areas compared to after the Tax Cuts and Jobs Act. So I guess after a lot of discussion, we finally have our technical correction on qualified improvement property. This is often referred to as a drafting error in the previous bill. And the way that our lawmaking authorities work and regulations, there was really no other way to correct this error other than with another major bill that goes through Congress. So we now have qualified improvement property essentially eligible for bonus depreciation and Section 179 depreciation. Let me remind you all what qualified improvement property is. Those are interior improvements to a non-residential property. Right, so this interior improvement needs to be made to a non-residential property after the building has already been placed in service. It doesn't apply to any of the specific building systems that are clearly separated in the regulations, such as HVAC, roofs, stairs, elevators, escalators, and so forth. It also doesn't apply to residential property, whether it's single family or multifamily. The definition is strictly for non-residential. So this is a retroactive correction, and we can certainly amend 2018 and 2019 returns to correct the method and life of the property so that there would be more deductions and hopefully refunds for some of you. There's some uncertainty whether we'll be able to go back to 2017 and whether the technical correction also applies back to the period of the expanded bonus depreciation that the Tax Cuts and Jobs Act passed, and we are running queries for all of you, for our client base, to try to identify and narrow down the number of clients affected so that we can start having these discussions about the additional deductions. It's important to note if you elected out of bonus or if you elected to be treated as a real property trade or business so that you can deduct your interest expense, this qualified improvement change has no benefit for you. But we expect that for some of you, there will be significant tax savings in real estate, hospitality, retail, and some other industries. Other business provisions worth mentioning, they can be of limited use, but for the companies that actually do have those tax attributes, they are as equally powerful as anything else that we just mentioned. So if you are a traditional C corporation and you had a significant amount of AMT credit carry forwards, you are expected to recover those carry forwards over 5 years starting in 2018. And these credits could only offset up to 50% of your tax liability. Now, actually, your corporate AMT tax credits can offset 100% of your tax liability in 2019. So that's a very quick monetization of those credits that you have paid for a long time ago under the alternative minimum tax regime, and you were thinking it's going to take 5 years to recover. Additionally, if again you're a traditional C corporation and you have any unused charitable contribution carry forwards because charitable contributions were subject to a 10% of taxable limit limitation, your limit is now increased to $25,000. So that's a quick way to increase your refund without any additional cash flow. And finally, what I wanted to address is a lesser known code section that allows qualified disaster relief payments to employees. So because we are in a state of national emergency, these payments would not be taxable to your employees. So if you have an employee or his or her family significantly affected by the COVID crisis, and the business wants to give them a one-time payment that is a reasonable payment to help them with living expenses and to recover from this disaster, you are definitely welcome to do that, and I'm sure that they'll appreciate it. This payment will still be considered a business deduction. However, it will not be taxable to your employee who's the recipient, and there is actually no dollar limit on that aid. It just truly has to be financial aid in a state of crisis. And with that, I'm going to turn it over to Wayne again, who is going to cover the individual provisions.
Thanks, Ileana. There's several key individual provisions in the CARES Act aimed to assist people during these difficult times. And the first one here is probably the most highly publicized that everybody's heard about in the news. It's the bill providing the $1,200 refundable tax credit for individuals. We'll go back one slide there. There we go. $1,200 refundable tax credit for individuals, $2,400 for taxpayers filing joint returns. In addition, taxpayers with children will receive $500 per child. There is a phase out. The rebate starts to phase out at adjusted gross income of $75,000 for singles, $112,500 for heads of household, and $150,000 for married filing joint taxpayers. And what that phase out is, it's a rate of $50 per thousand of income once you get over that excess of $75,000 and $150 for married joint. So the amount phases out entirely at $99,000 for single taxpayers and $198,000 for people filing joint returns. The taxpayer generally does not have to do anything to claim the rebate. We've got a lot of questions on this. The IRS will calculate the amount of the rebate based on the taxpayer's 2019 federal income tax return or 2018 if the taxpayer has not filed their 2019 return yet. And they're going to send the payment to the taxpayer either based on direct deposit if they have the bank account from prior filed returns, or just mail a check out if, we've gotten that refund that way in the past. Checks could take, we're hearing that the direct deposits could be here in the next week or two. Checks could take, 4 to 6 weeks. So that's the time expectation on those. Also, taxpayers receiving rebates do not have to pay income tax on those rebates at all. As far as seniors with Social Security, we've heard some conflicting things also, that a lot of seniors, if they're not required in meeting the income level with their Social Security check, do not file 1040 tax returns. We have heard that IRS will coincide with Social Security records and see who is eligible and direct deposit the rebate that way without having a 1040. However, we think here as a firm, it's probably best to go ahead and file those returns just to make sure there's no holdup on that. Some other key provisions, filing due dates are automatically extended from April 15th, 2020 to July 15th, 2020. IRA contributions for the 2019 tax year can also be extended to July 15th, 2020. You know, traditional IRAs, Roth IRAs, et cetera. We have some more time on those. If we owe money with our 1040s for the 2019 year, we can also defer federal income tax payments due on April 15th to July 15th without penalties and interest for underpayment or you know, late filing, late payment. Taxpayers do not need to file any additional forms or call IRS to qualify for this. It's automatic in their computers, so it's just going to automatically go to July 15th for everyone. One point to note, it's kind of unclear that we've seen so far if informational returns. There's a lot of our international clients have 54, 71, 72 forms. If we have foreign subsidiaries involved or have a foreign parent, a lot of the information returns have not been specifically set a July 15th due date yet. So we're paying attention to that in our client base. We're going to extend everybody that has those informational forms on April 15th just to be safe. Estimated payments, federal estimated payments due April 15th, the first quarter for 2020 is also deferred until July 15th. What's very strange and interesting is currently the federal second quarter estimated payment is still due June 15th, 2020. So we'll technically make our second quarter in June before our first quarter in July if we wanted to plan it out that way. So that's interesting, but that is the case right now. Georgia is following the federal extended due dates as far as, you know, filing and payment of tax. Those are also July 15th, but if you have other states involved, definitely check those. The states are kind of their own animal and, you know, come up with their own due dates. So that's something to be aware of. Retirement plans have several changes to help out now in this time of need. For those under age 59 and a half, in the past, you'd have a 10% penalty if you took distribution from your retirement account. Well, now that penalty is waived on early withdrawals up to $100,000 from retirement plans for anyone who's diagnosed with COVID-19, whose spouse or dependent is diagnosed with it, who's experienced adverse financial consequences and other factors. So bullet point number 3 there, I think that pretty much blankets everyone. If you would need to take this, it should be fine, and you would avoid that 10% penalty. Also, coronavirus related distributions may not exceed $100,000 in aggregate for the taxable year, and taxpayers may elect to ratably spread the income over a 3-year period beginning in taxable year 2020. So if you take that 100, you can spread that out, you know, pro rata over the next 3 years and defer your income tax paid on those. No interest or penalties involved with doing that. Another opportune thing that they did was you can also avoid income recognition in future years by repaying the distribution back that you took out all in the 2020 year. So if you took out 100 this year, you know, you pay your 1/3 at the end of this year, and then the following year you have enough cash to pay it back. You can certainly do that. It's kind of a 3-year rollover period, if you will. Very advantageous to take advantage of if you need to. This is a real big one here. Waiver required minimum distributions. Typically upon attaining age 72, individuals would have to take out a required minimum distribution from their retirement account. The government wants their income eventually, and that is done through the RMD. Well, they're waiving that now for defined contribution plans. 401ks and IRAs are included in that. So if an individual has an RMD required, chooses not to take that, doesn't need it this year, wants to leave the money in the investment account, hopefully it's going to recover here, you know, in some sooner than later time frame. You do not have to take that money out this year. Also, the CARES Act doubles the current retirement plan loan limits for a period of 180 days following the date of enactment of the CARES Act, which was last Friday. In the past, you're eligible to take up to $50,000 per year out in loans from your retirement plan. Now you can take $100,000 out or 100% of your vested account balance if you're impacted by the COVID-19. Charitable contributions for the 2020 tax year, the deduction percentage limitation for charity of cash to public charities has been removed for individual taxpayers. 2019, you could do up to 60% of your modified adjusted gross income on your Schedule A for charity. Now you could theoretically do 100% of your modified adjusted gross income. And totally eliminate your income tax liability, take your income to zero in the 2020 tax year. One quick note, beware of state differences that may be in place. Not all states conform to the federal rules, and states may at some point come back in the next month or so and say, we're not going to conform to that. You'd owe a lot of state tax, possibly in some areas. So just be aware if you were planning to do that. Also, beginning in tax year 2020, individuals who do not itemize and can still deduct up to $300 in charitable contributions made to churches, nonprofits, schools, medical institutions, and other organizations as an above the line deduction in calculating adjusted gross income. So a good example of this is if someone has itemized deductions, but the standard deduction has gone up so high now in 2019, if you're taking the standard deduction, you can still do a $300 charitable deduction above the line, meaning before you get to your standard deduction, and have that count against your income as well. So it's not a lot of money, but it's kind of a slam dunk as far as a planning concept for this year. This one's big for individuals and businesses it applies to. It removes the excess business loss limitation for the 2018 through 20 years. The 2017 Tax Cuts Act imposed a limitation on business losses for clients that if they're single, if we can put that back one more, there we go, thank you. If they're single, they can only claim up to $250,000 in business losses, $500,000 if married filing joint. If you had a large company loss in a year, you could take those amounts, but would have to suspend that excess business loss to a future year where it could be offset by future income. Well, the CARES Act now is removing this limitation for the 18 through 20 tax years. And as a result, taxpayers will now be able to use these losses in 18 through 20. And as Ileana was talking about with the NOL carryback possibilities, this ESL would also be a NOL type item where we can look at clients' tax situations, possibly do some carrybacks and get some refunds. So we're paying very close attention to that. Student loans, Ileana mentioned this a little bit earlier, but once again, on the individual side, if your employer pays up to $5,250 on your student loan before January 1st, 2021, they were all excluded from your gross income. Installment agreements for those taxpayers under a current installment agreement with payments due between April 1st and July 15th, 2020, those are going to be suspended. Taxpayers who are not currently able to comply with the terms of the installment agreement, you may opt out to suspend payments during this period if you prefer. And IRS will not accrue interest or take any action on you if you choose to do that. And with that, that is the end of our individual section, and I'll turn it back over to Michael Bowling.
Thank you, Ileana. Thank you, Wayne. That was awesome. A lot of detailed information there. I know that's a lot to take in. We actually have a few minutes here, and I've been kind of going through all the questions that have been submitted during registration and through this presentation. We may have time for, let's see if we can get two of them in. Ileana, can you discuss a little bit further about how employees making more than $100,000 per year are treated in the PPP and how they affect any possible loan forgiveness? There seems to be still a lot of questions out there.
Yes, absolutely. I think that we are all looking forward to more guidance from the Internal Revenue Service and from the SBA for those calculations. But it is important that higher compensated employees impact both the maximum loan amount and also the loan forgiveness amount. And I believe they impact the computation in two very different ways. So when you're calculating your maximum loan amount, you are expected to reduce the compensation of any employee down to an annualized level of $100,000, whether or not they have been employed for the full year or the partial year. That essentially will give you a lower maximum amount to borrow, but still give you funds to cover what I guess Congress has determined to be a reasonable salary of $100,000. I was playing with some of the FAQs as well, and I noticed that there were questions about shareholders of S corporations and whether they count as payroll cost. And our interpretation is that yes, shareholders are also included, subject to the same limitation of 100,000. So that is for the loan amount. For loan forgiveness, we end up with a slightly different calculation that has to do with the reduction in workforce compensation. Essentially, the calculation for reduction in workforce compensation only impacts your loan forgiveness amount negatively if you have reduced the compensation of any employee who makes less than $100,000 of annualized salary by 25% or more. To me, this means that if you have to adjust compensation, commission structures, and so forth for your higher earning employees that are over $100,000, that reduction does not impact your calculation for reduction in overall workforce compensation. Therefore, you should be able to have a higher loan forgiveness amount.
Excellent, Ileana. Thank you for that. Wayne, as it relates to the eligibility for the sick leave and family leave credits, what sort of documentation should the employer get again and maintain?
Yeah, Michael, that's actually a really good question. And we want to be sure as a business we have the correct documentation in the file. So, you know, if an employee is going to take sick leave or family leave and we're going to actually claim credits for it, at some point there could be a chance IRS is going to come back and say, you know, prove, you know, what was the reasoning, you know, what was the cause. And we can substantiate eligibility if the employee, and it's their responsibility, and we can make sure our employee does this, but they need to provide us their name and a statement, the date or dates the leave is required, the statement of COVID-19 related reason that they're requesting leave and written support for the reason, and a statement from them why they're unable to work or telework or any work for any reason. And then, you know, a leave based on quarantine, for example, a statement from the employee would include the name of the government entity ordering the quarantine and, you know, the name of the healthcare professional advising the self-quarantine, things of that nature. If they're having to stay home, you know, in regard to their child, pretty much, you know, the name of the school, a statement saying that no other person will be providing care for the child during the period. We'll need to have that documented in our files, and then claim the credit should not be a problem.
Excellent. Thank you, Wayne. I think we're just about out of time, but I would certainly like to thank everyone for attending today's webinar. We do hope it helped you kind of unpack and get your arms around the CARES Act. Just know that HOB Gross-Collins, we're here to assist you. This is a pretty historical time. And, you know, again, on behalf of Gross-Collins, we hope you all stay safe, stay healthy, and let us know how we can help you. Take care. Thank you.